Good afternoon and welcome. I'm Helen Rowley, founder and the Chief Investment Officer of Governmental Advisors, LLC, a Colorado-based independent fee-only investment advisory firm. Today, we will discuss 3 long-term investment trends after COVID-19 pandemic. I will share my thoughts with you through a short presentation. During the presentation, I cannot see you, so please save your question until the end, but you can always type in your question in those chat boxes. So once I'm finished my presentation, I will return to the screen and I can see your questions. I will answer your questions. Okay, let's get started. All right. Well, even though the title of this presentation said 3 long-term investment trends after COVID-19, I guess I was a little too optimistic while I was creating this presentation, because we're certainly still hasn't reached the point of after COVID-19 yet. We're still in the middle of the pandemic. But today I want to touch on 2 main things, 2 main subjects. The first is how COVID-19 pandemic has changed the markets, as we know. And the second point is what are some of the 3 new investment trends that I observed since the pandemic? So how did the COVID-19 pandemic, how has the COVID-19 pandemic changed our markets? As many of you recall, in the spring, March this year, which feels like ages ago, that was the first time we heard about this pandemic, coronavirus outbreak. At that time, governments worldwide, including our own government, many states governments, took drastic action by shutting down the economy completely, except a few essential businesses. By shutting down the economy in order to deal with the spread, in order to contain the spread of the pandemic. So far, we're still evaluating whether that drastic measure is actually effective in terms of containing the spread of the pandemic. But one thing we do know for sure is such lockdowns and shutting down the economies have seriously devastated economies worldwide. That included our own, the economy in the United States. So in response, the government who shut down the economies also put out a massive stimulus through the central banks, as well as the stimulus measures, from the government. So some of the stimulus measures, including rate cuts, for example, United States, the Federal Reserve cut interest rate to near 0 in March. And the Federal Reserve also announced that they intend to keep this low interest rate close to 0 through 2022. And the Federal Reserve is not the only central bank who cut interest near 0. Bank of England did something similar, and the European Union central bank also talking about, actually this morning, they're talking about that they have no problem to cut their benchmark rate to below 0. So there are many rate cuts. And then there are asset purchases. For example, Federal Reserve purchased $500 billion in Treasury securities. So all these rate cuts as well as assets purchases did is to inject this huge amount of liquidity or cheap monies into the economy. And we will about the impact of this massive stimulus later. And then, of course, the central banks also took certain measures to try to support the banks for the purpose of, to keep the banks lending to small businesses and lending to consumers, support the consumer spending. And in United States, the central bank also took measures to support the borrowers. For example, in terms of mortgage payment, both Fannie Mae and Freddie Mac announced that for COVID-19 relief measures, they will defer some mortgage payments for up to 12 months. They will waive certain late fees or suspend foreclosures and evictions for 60 days. So all these measures together became massive stimulus packages and injected money into the financial markets and the economy to help stabilize the economy as well as the financial markets. So as all this money flooded into the into the economy and the financial markets, it has a significant impact. One of the significant impact is the debt level. As you can see from this pink chart, that the federal debt held by the public is projected to exceed about 100% to GDP in 2021, which is the highest in our nation's history. The last time we have, our debt exceed 100% GDP was during the World War II. So this is the only second time in our nation's history our debt is reached such high level. And as you can see, the projection shows their debt level is going to continue rising. So the current projection is the federal debt in 2030 will equal to about 109% of our GDP, which is about a 30 percentage points higher than it was at the end of 2019. With this massive debt, as well as the massive injection of liquidities into the financial markets, into the economy, in response, the 10-year Treasury yields has reached a historical low. As you can see in this chart, it's basically it's a straight line, almost a straight line down in 2020. And then another impact of this massive stimulus is the devaluation of US dollars. As you can see, US dollars is kind of on the devalue, kind of a flat prior, actually kind of even on the rising period, just a little in the March where we were right before we go into the pandemic lockdown. But once we start lockdown, you can see the value of the US dollars just keep going down. And so the depreciation of those three factors, the increasing debt, lower the yield, as well as the depreciation of US dollars, will help drive the three investment trends that I'm going to talk about. And there's one more, which is a geopolitical factor, which many of you heard a lot about. And so that's what we call decoupling from China. First, let me define decoupling. Decoupling really means that to move, manufacture or relocate factories or move supply chains out of China. So this actually started before the pandemic, but it's from the low-end industry, was driven by different reasons. Before the pandemic, some low-end industries, when I say low-end, I'm talking about manufacturers of paper cups or shoes, those very labor-intensive factories and industries. Those has already started shifting their supply chains and the manufacturers outside of China, mainly due to the increase in labor cost in China. After 30 years of booming economic growth, China no longer has the cheapest labor cost. So the low-end manufacturers have started shifting their factories and supply chain out of China to nearby countries such as Vietnam, Malaysia, Thailand. So those countries that still have cheaper labor costs than China. So the trend has already started before the pandemic. But what the pandemic really crystallized is to many Western democracies, especially the United States, really crystallized how much our economy depends from China. For example, China controlled 80% of the pharmaceutical ingredient supplies, worldwide. And China controls the majority of the PPE, the personal protection equipment. And so the pandemic really crystallized how much our economy is depending on China. So there's a new gained sense of urgency. And also, this picture I showed here is kind of a visual presentation of the China decoupling between United States and China. It's a little bit misleading because the decoupling from China doesn't just happen between United States and China. Other countries are already doing it too. For example, Japan, in the spring, Japan offered some of its manufacturers, you basically use financial incentives to encourage their Japanese manufacturers to move back to Japan. And India, this summer, because of the border dispute with China, So India actually banned over 100 Chinese apps from the Indian market, and Indians are taking other actions to decoupling from China. And the United Kingdom told China recently that it will not use China's 5G provider Huawei. So there are other countries are doing the decoupling from China, but of course, United States is the most consequential one because we are China's largest trading partner, and China is our largest trading partner. And the United States and China are two largest economies, and we are engaged in this great power competition. So I can talk all day with this decoupling and geopolitical conflict. So if you don't mind me brag a little bit, I have a new book. It's called Backlash. It's talking about China, talk about the geopolitical conflicts, talk about China issues. So it's available on Amazon. Please feel free to check it out. So now I'm going to cover, based on those main points I just laid out. So what are some of the 3 new investment trends that I see? The first one is dividend-paying stocks. Dividend-paying stocks are the new bonds. Well, this one, it's not exactly a new trend, but I think it's a trend that has been intensified since COVID-19 pandemic. So the pandemic did a couple of things. One is, as I mentioned earlier, because the government responds to the lockdown by injecting massive amount of money, as well as cutting interest rate, to help stabilize the markets, financial markets, and the economy. What it did is the yields on government bonds has been very low. And if you take into consideration of inflation, even though inflation rate is low, but if you have a near zero yield on the government bond, then the inflation is not zero. So once you take into account the inflation, sometimes you get a negative real yields. And that really pushed many investors to reconsider, does it still make sense to invest in bonds with close to negative yields or very low yield? So the low yield are really pushing more investors to seeking returns into a little more risky investments. And so there's a big discussion in the investment community about is the traditional 60-40 still makes sense. The 60-40 has been like the gold standard, basically refers to, a portfolio invests 60% in equity, 40% in fixed income, as long as you balance it on annual basis, keep this, asset mix. In the last 44 years, it has generated fantastic return. But now the question is, well, given the bonds yield is so low, plus with this massive debt, bonds are not, especially government bonds, are not necessarily safer, stable investment, in the foreseeable future, at least now until the next couple of years. So is the 60-40 still makes sense? Actually, the Professor Jeremy Siegel from University of Pennsylvania, he's a long-term stock market bull. Many of you probably heard about him. He proposed that the 75-25 is the new 60-40. So basically what he's saying is, instead of stick to 60-40, invest in 75% in equity and 25% in bonds. So, and in the 75% in equity, increase your holdings with dividend paying stocks. This way you get a price appreciation, you get a growth, as well as current income. Because if you look at some of the dividend-paying stocks, their dividend yield is much higher than what you can get from government bonds. Especially given like a 10-year yield right now is only about 0.69%, which is less than 1%. So that's so COVID pandemic really accelerated this trend. Now, even with my own clients, I'm looking at more to include more dividend-paying stocks to replace, not completely get rid of bonds, but to replace some of the low yield bonds. So another trend is because the devaluation of dollars, I showed the chart earlier, because of devaluation of dollars, I think another trend we'll see is to dial up allocation in your portfolio in international assets as well as commodities. Because the devaluation of the dollars, so when you invest internationally, some international markets have even in their national bonds, they have higher yield compared to US government bonds. So not only you get a higher yield, but when you convert back to US dollars, you get more dollars because the depreciation of dollars. And also, of course, commodities, the first thing come to mind is gold. Gold has been doing really well. Gold investment have been doing really well since the pandemic because the flight to safety. So consider going forward, the depreciation of dollars is a long-term trend. I would encourage you to think about dialing up allocations in international assets and commodities. And the last one, it's easy to say, but it's more difficult to do, is you may really want to think about limit your investments in certain companies that have a significant geopolitical exposure. Because right now, especially in the United States, right now, the only thing united both parties is their attitude to China. And so it doesn't matter who's getting elected to the White House this November. I expect the geopolitical conflict between the US and China will continue. So that will reflect in your investments. For example, I'm really concerned about Apple because Apple has 30%, basically close to a third of its revenue comes from China. And so Apple is very, very vulnerable. The Chinese government can easily retaliate United States by either banning the Apple phone from selling in China or take actions against the Apple app stores in China or other Apple products. And Apple is such a wildly held stocks in almost all mutual funds and in many individual investors' investment portfolio. So that impact will be very significant. And so I would recommend limit your exposure to companies like Apple. And same thing when you think about it from the Chinese standpoint, I will not invest in a Chinese company such as Huawei. Huawei is a world leader, technology leader in terms of 5G. But again, because of geopolitical competition, that many countries, at least the Western democracies, are taking actions, basically preventing Huawei from take part in their country's 5G market. And so if you invest in Huawei, you are exposing yourself to such geopolitical exposure. So for point 3, that really take a lot of digging and analysis to decide what investment or which company you want to reduce your exposure from. And here's the last page of my presentation. I want us to keep in touch. Here you can see my email, my website, redmeadowadvisors.com. Again, I encourage you to check out my book, and it's called A Backlash. And thank you very much. Now I'm going to try to switch back to the main screen so you can see me, and I'll see if I get any questions. Oh, right. Okay, so I do have some questions. This question is from Timothy E. The question is, what does it mean to have an interest rate below 0? So yes, Tim, your second part is correct. You're basically saying, am I paying the bank to keep money on deposit? Yes, that's already happening in Europe. Like countries like Switzerland, they have had negative interest rate for the last couple of years. So basically, the depositors are paying the bank to keep their money. But for countries who have high saving rate, like Germany, it seems like it's just a national culture to continue to save money, and people still feel safe to put their money in a bank. So despite the negative interest rate, the government like Germany cannot push people into more risky asset environment. People still would love to, for safety, keep their money in a bank. But I think United States, because our culture is different. We are more capitalist culture. Not to say that Germany is not, but definitely we are more risk taking. So the fact that you have all this stimulus and cheap money and low yield really driving. I see this a lot, that even for my clients, more investors want to take on more risk in order to get a better return. So the next question is, what do you foresee as a reaction for to the election on the stock market? That's a really good question. That depends on industries or sectors. So, I will refrain from forecasting what's going to happen, but I do think if you compare the tax policies and economic policies between Joe Biden and Donald Trump, that depends on who gets elected on November. Hopefully by November 3rd, we will know who gets elected. Then different sectors will benefit. For example, there is analysis by Bank of America basically suggesting that if Joe Biden gets elected, because he proposed to increase corporate tax back from the Trump tax cut from 21% to 28%, and also he's gonna reduce several incentives that especially technology companies enjoy right now. So the technology company has been doing really, really well, especially during the pandemic, since we are taking everything, work from home, communicate online. So if Joe Biden gets elected, there's an estimate from Bank of America that the earnings of a technology company probably will be reduced at least 9% throughout the next year, at least. So because his tax policies. If Trump gets elected, I can see that the defense industry investment will continue to do well, and financial market will continue to perform well. Probably pharmaceutical will do well. And again, with Joe Biden, then he has this massive plan for green energy. So anything related to green energy, electrical cars, solar, and battery related to electric cars, I think those sectors will do very well too. Let me see. Are there any other questions? Okay, I do not see any other questions in the chat box. So I'm just gonna type in, well, actually you can see my emails on the website. So thank you for logging to today's web session. I really appreciate everyone who attended the session. I know that we've been doing so many things online. Sometimes it gets tiring. Hopefully, I'm praying for the vaccine will be successful and will contain this pandemic. Hopefully, I'll get to see all of you lovely faces next year in person. So have a great, blessed day and stay safe, stay healthy. Thank you.